Hello, very good morning to all. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights by OANDA. Very good morning. Today will be Tuesday, the 21st of May 2024. So before we start our daily dose of market insights, pardon me, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, no financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so yeah, just to make sure that the screen is working fine. Okay, it should be working fine. Okay, it's moving. Okay, so before we jump straight into the short-term technical outlook on the various cross asset classes, ranging from the major stock indices, the major US dollar pairs, to key commodities, that is i.e. the gold XAU/USD, followed by the West Texas crude oil. Let's have a recap of what has taken shape earlier yesterday in terms of the cross asset performance in relation to their respective key economic data and events flow. So let us start with the events flow first, because yesterday we do have an unfortunate event that took shape around in the Middle East region, where the death of the Iranian president together with its foreign minister due to the crash of their helicopter over the weekend. So right now there's actually various sketchy reports in depth of what you call it, their succession plan, and also there's some conspiracy theory pointing to the crash of the helicopter, because do not forget, Iran is a key player indirectly in this ongoing hostility between Israel and Hamas. And do not forget, Iran is also indirectly backing some of the rebels that is actually preventing the oil supply transportation along the Red Sea. So what we could see over here, that yesterday gold reacted positively to this potential update in geopolitical risk premium, where during the Asia session that I highlighted yesterday in the short-term technical outlook, gold prices remains on a short-term bullish buyers uptrend. First resistance 2,450 we actually made yesterday before pulling back during the European and the US session. So where does gold goes from here? Stay tuned much further. Later I'll share with you the short-term technical outlook after I cover the intermarket analysis. All right, so this is one of the important flow yesterday. And also oil prices, very strangely, during the Asia session, it managed to caught a bit as well. For the West Texas crude oil, it traded slightly above the $80 per barrel mark, around $80.15 per barrel, before retracing down during the European session, and also during it can actually inch much higher above the $80 per barrel, which is also the 200-day moving average that is acting as a near-term resistance there as well. So speculators seems to be pretty much watching this around this $80 per barrel, despite the fact that there could be a potential we call it geopolitical uprisk in the Middle East region, where oil could be used, unfortunately, as a diplomatic choice or weapon for negotiation. So on one of the reasons I reckon that why oil prices didn't rally as much as gold, because the fact that there is upcoming OPEC plus meeting, where short-term speculators are pretty much uncertain whether Saudi Arabia, together with the cartel, which is OPEC plus, will extend its ongoing supply cuts beyond June that was agreed earlier on at the start of this year. So that actually causes the speculators to actually pare down bullish bets, despite the fact of that, right, on bullish bets on West Texas oil, despite the fact of that potential rising geopolitical premium that is coming out of the Middle East region after the death of the Iranian president. So now For stock market, the US benchmark stock index, let us have a quick look at my chart over here. What we could see over here is that the US benchmark stock index has pretty much of a positive footing yesterday. Almost all the major indices actually closed in the green, except for the Dow Jones Industrial Average. Okay, let the screen refresh for a while. Okay, so the movement of the US market was yesterday led by the Nasdaq 100. Later I'll explain to you why Nasdaq 100 is leading the fort yesterday. It managed to actually breach fresh all-time intraday high yesterday, above last Thursday's all-time high. That means another fresh brand new all-time high for the Nasdaq 100, up 0.7%. Then the S&P 500 is almost unchanged, slightly positive, up 0.09%. The Russell 2000 up 0.32%. And the Dow Jones Industrial Average underperformed by negative 0.5%. So the fact that why the Nasdaq 100 actually lead the pack yesterday was because of optimism that is being seen in this mega cap technology stocks. So not forget the S&P 500 as well as the Nasdaq 100, they are heavily skewed towards the I would not say seven, the five mega cap stocks, excluding Tesla and as well as okay, Facebook. All right. So Microsoft gained 4.22%, Apple positive 0.62%. The most is Nvidia taking on to the chip sector, the positive move in the chip sector. So we'll see that the entire semiconductor sector on the S&P 500 managed to close rather positively yesterday, with the Nvidia the biggest weighted cap inside the S&P semiconductor sector, up positive 2.5%. So like I explained earlier in my daily dose of market insight late last week and also yesterday, I shared with you all the key component driver of the ongoing rally in the major US indices is actually driven by two factors: micro factors, which is earnings growth upgrade, and as well as positive momentum, rather than macro factor. Okay, macro factor is we're talking about US 10-year Treasury yield that is still on the uptick. Fed speak that is less dovish, all right, potentially telling the market, hey, you are actually getting too aggressive of pricing two interest rate cut for this year. Okay, so but market is driven by micro, which is earnings potential and growth potential, and as well as momentum. And why do I say that the Nasdaq 100 actually outperformed yesterday is due to this all important Nvidia earnings that is going to be released on Wednesday after the close of the US session. That means i.e. Tomorrow Wednesday, the close of the US session. And later I'll share with you all the chart of Nvidia when we actually do the intermarket analysis. Then why Nvidia is important? Because Nvidia is actually the third biggest weightage component stock inside the S&P 500. That means, i.e., if Nvidia on Wednesday continues to actually show robust earnings growth and very, very good earnings guidance going forward, it could actually detect the short-term momentum outlook on the S&P 500, which could actually spill over to the rest of the US stock market. And also given the fact not even the the Nvidia has a huge weighting in the S&P 500, being the third biggest component stock over here. If I could expand my screen so that you guys could see. Okay, over here, even also as well as the Nasdaq 100. Okay, is the third biggest component stock inside the Nasdaq 100. So definitely, given these two key important major US stock indices, if there is a continuation of that positive bullish momentum that is being seen in Nvidia after the release of their earnings result on Wednesday, it could potentially continue to drive the short-term bullish momentum that is inherent in the S&P 500, the Nasdaq 100, and as well to some aspect on the Dow Jones Industrial Average, at least in the short term. Okay, so this is the intermarket correlation I share with you all. And yesterday, the dollar traded sideways but remains on support. Why? Because it's being supported by this ongoing, very interestingly, US 10-year Treasury yield that is going to that is continuing to stage is the recovery after the losses that was inflicted in that so-called rather market is viewed as a robust CPI release on last Wednesday. But I share with you all this, the services side of the component continues to be elevated, and we start to see a slew of Federal Reserve officials coming out to actually warn the market that interest rates, means i.e. the Fed funds rates got to stay at this higher level for a longer period of time. That means i.e. there could be a risk of a potential mispricing of what markets view that is going, the Fed will be going to cut at least 2 times this year. All right. So let me share with you first, step by step, what is going on the latest Fed speak. So latest Fed speak yesterday, we do have 3 officials speaking. Okay, which is Jefferson, Bostic, Barr, and in fact one more Mr. All right. So Bostic itself, we know that I've been highlighting this. He belongs to the less dovish camp among the Fed officials, and in fact slightly skewed towards more on the hawkish side of the story. So yesterday he did mention that he expects a higher steady states for rates. That means continue to reiterating his cautious stance that hey, this year that his point of view is this year high odds of no interest rate cut. And Barr said that restrictive policy needs further time to work. Another official that is now skewing towards more towards the Bostic side camp, stating that we need to have interest rates to maintain at a higher level for a longer period of time. And the other officer called Meister, saying that 3 rate cuts this year is no longer appropriate. All right, so this not so dovish. That means it's still skewing towards at least 1 interest rate cut for this official. And that's one of the official. Jefferson said April inflation data is encouraging. All right. So to me that yesterday's Fed speak is more like a balanced tone among the less dovish and the more dovish officials. But what market has starts to imply in terms of the treasury market. Okay, so you look at the treasury market, it starts to price in a rather less dovish Fed going forward. Why do I say that? Because the treasury market yields, US treasury market continue to inch higher above the closing price of last week slide after the US CPI data. So let's look at the price action of the US Treasury yield. Okay, so you look at the US Treasury yield, the 10-year, okay, representing longer term inflationary trend. This is the 10-year US Treasury yield. Okay, and where it bounced off from the key 200-day moving average, the lower boundary of the medium-term ascending channel that I drew from the low of 31st of January this year at 4.32%. Also previous my medium-term range resistance breakout turns into a pullback support. Price tested and staged this rebound in the last 3 days. It managed to shape 3 consecutive day of positive price action, and yesterday close managed to surpass above the 50-day moving average and as well as the previous bearish candlestick high. Okay, the previous bearish high that was inflicted, this black bearish Marubozu candlestick on last Wednesday, that was inflicted by that ex-CPI, ex-post CPI data releases in US. And the 2-year Treasury yield that is much more sensitive to Fed policy is also rising as well. And this one, it clearly surpassed above the 50-day moving average by a fair bit after bouncing off from a key medium-term support at 4.72% as well. Managed to recover above the 200-day moving average after a whipsaw of it on last Wednesday, ex-post CPI data. And very clearly, this price action managed to surpass above the high of that previous bearish Marubozu candlestick high that was inflicted during the ex-post US CPI data release. So what we could see is that net all in all, the US Treasury yield, the market participant in the US Treasury markets, is now expressing a concern that after a slew, this latest round of Federal Reserve officials speech or speak, we call that in short form, that the pricing of 2 interest rate cut before 2024 ends that means on the Fed funds rate, is slightly much more rosy on the upside. So that actually kept the US dollar supported. So if you look at the US dollar index, it also managed to bounce off from its 200-day moving average and the key medium-term support at around 104.22 level, okay, which is also the lower boundary of the minor ascending, medium-term ascending channel that I drew from the low of 28th of December last year. Very similar to the price action on the Treasury yield. If you look at it, right, managed to bounce, okay? But except the fact that the US Treasury yield, the 2-year and the 10-year, the pace, the magnitude of the bounce is much more significant than the US dollar, right, index, okay? So this is for the story. And over in Japan, very interestingly over here is that in Japan, the benchmark bond yield hits decade high. That means it's also implying that market participants now viewing a potential rate hike to come as early as July this year in Japan for BOJ. That means for BOJ to continues to actually normalize its rather decade plus of ultra dovish monetary policy. Still recall in previously on 19th of May, 19th of March, pardon me, not May, 19th of March, they starts to actually remove off their short-term negative interest rate. And also they remove off the reference level on their 10-year JGB bond yield, but they actually kept a rather dovish portion of it, stating that if that 10-year Treasury JGB yield going to rise as a faster pace, they will come in and starts to buy JGB to actually prevent the 10-year JGB yield from spiking up erratically on the upside. So it seems to us that at that point in time on 19th of March, Bank of Japan is still guarding that 10-year JGB yield, preventing up any erratic spike on the upside. Markets view this as still maintaining that dovish, indirect shadow dovish monetary policy that causes the dollar yen to actually spike up to fresh 34-year high against the dollar. That means the dollar yen spiking to about 160 level before coming back down in the last 3 weeks or so due to that so-called alleged BOJ intervention to sell dollar buy yen. But what we could see fundamentally right now is that Bank of Japan is not in the JGB market to continue to buy JGBs. Why? Because if they continue to buy the JGBs, the bond yields will not spike up yesterday and even last week also when they start spiking up. Later I'll show the chart of the JGB bond yield. And what's interesting over here is that due to the spike up in the yield, all right, over here, there is this particular statement on the highlight. Yes, so there is this overnight index swap market, which is a something like a forward derivative that take it like a futures, it's something like a futures contract that market speculate on BOJ interest rate policy, except that futures market is a centralized market. This overnight index swap market is actually market made market that is done by interbank dealing desks. So view this as a tool where market use it as for hedging and speculation of future BOJ interest rate short-term policy, means the overnight rates. All right. So now the overnight index swap is actually pricing around a 57% chance. That's more than 50% chance that BOJ will lift rates. That means they will do another hike again in July, compared to only 50% odds at the start of the May, due to this rising JGB yield. And a rising JGB yield actually implied that the BOJ is not in the JGB market to buy up bonds, where previously they did mention that on the 19th of March meeting, they may do so. Okay, that means their action telling us that they are allowing the JGB bond market to be more dictated by market forces rather than their intervention. Okay, so this is what happened in the JGB bond market over here. So let's look at the JGB yield instead. Okay, over at my screen. Okay, where is the JGB yield? I think is this the one? Is this the one? Nope, not that's the one. Yes, this is the one. Okay. Okay, very quickly, let me share with you what do I mean by this. Open, open, open up. Oops. Open up. top one. Okay, so this is the 10-year JGB yield. So this 10-year JGB yield is kind of being controlled by BOJ. Why? Because they previously, the yield curve control program, they target the upper limit and the lower limit. So previously, the upper limit was 0.5. Then over the last 1.5 years, they start to shift the upper limit higher and higher. And prior to the 19th of March meeting, they use the 1% level as a reference level. Then after the 19th of March meeting, they remove it as a reference level and allow it to go free flow. But they keep a caveat saying that if the yield continue to spike up too high, they will continue to monitor this market and buy bonds to depress or slow down the pace of increase in JGB yield. And if you look at the pace of the JGB yield in the last 1.5 weeks or so, it's going to rise rather steeply and now approaching the 1% level, and currently right now is 0.98%. It surpassed the previous peak high of 1st of November at 0.96%. So given that the movement of the current pace of increase in the JGB yield, it implies to us that the BOJ is not in the market to actually to suppress the pace of increase, the rather current steep pace of increase in the 10-year JGB yield. And what's interesting over here is that the 30-year, it is the 30-year, the 30-year rose by a much more steeper pace of increase. Over here, you look at the 30-year pace of increase. So this 30-year pace of increase is more dictated by market forces rather than BOJ. And the current rate of 2.09% is the highest so far that is being seen close in to almost a decade plus. So if I go to the weekly chart, okay, this is the highest level since April 2011. Okay, and if you go to the 2-year, very similar as well, going to rise to 0.345%, also rather steep. Okay, so this 2-year JGB yield is very sensitive to BOJ short-term monetary policy on their overnight interest rate. So given the rise of the 2-year JGB yield, market participants is also now have pricing in a higher odds of another round of interest rate hike in Japan that may be coming closer to July, as shown earlier on by the overnight swap market in that Bloomberg article that I expressed earlier, where the Bloomberg article stated a 57% odds of a chance of BOJ hiking and implementing another hike on their short-term interest rate policy in the July meeting. That means 2 months from now. And if you look at this current rise of that 2-year JGB yield, now at 3.5%, is the highest one since May 2009. So what we could see over here is that the current rise in the JGB yield that is not being kind of controlled, indirectly controlled by BOJ, is the 30-year JGB yield and the 2-year JGB yield all rising, all rocketing to fresh decade plus high. And how does it imply relatively? So if you look at the, okay, so now let me redo this screen. All right, so if I now compare the relative spread between the 10-year US Treasury yield minus of the 10-year JGB yield, the premium that the US Treasury commands over JGB yield has been falling rather pronounced in the last 1.5 weeks after the breakdown of the previous key medium-term support at 3.6%. So this, what you could see over here is that the 10-year US premium over the 10-year JGB yield continue to string, which means that the 10-year US Treasury is no longer considered attractive versus the JGB because the yield premium of the 10-year continue to string. Similarly for the 2-year as well. That means taking into account of the spread between the 2-year Treasury yield minus the 2-year JGB yield also continue to string as well. All right, after the break of that 4.57 key medium-term support over the dotted red line. So what does it imply over here in terms of alternative investment between, that means between relative fixed income investment between US Treasury and JGB? That means right now, the JGB bond is much more attractive compared to the US Treasury because of the US Treasury premium yield shrinkage. So if this yield premium shrinkage continue to shrink, that means i.e. JGB bonds will become much more attractive for Japanese lifers, which is the Japanese insurance company that is one of the biggest player in global fixed income market, especially in the US Treasury market, where in the last few decades, there is no good alternative fixed income in the local market, which is Japan. All these Japanese lifers has a huge overweight fixed income global portfolio allocation in US Treasury. If the US premium continue to shrink, that means the US Treasury yield premium continue to shrink against the JGB, as I showed you in my screen over here. That means these Japanese lifers will have a higher propensity to allocate more of their global fixed income portfolio towards local JGB. That means there will be a significant shift away from US Treasury bonds towards local JGB market. If that were to happen, or that pace to quicken, it could actually prevent the dollar yen from moving up higher, because right now one of the fundamental metrics is not actually supporting an uptick, a pronounced uptick in dollar yen. So this is what I'm going to trying to actually say to express on this narrative that could potentially play out based on a intermarket market perspective towards the dollar yen rate, given the fact that JGB yield is spiking up. The spike up in JGB yield rose at a faster pace compared to the pace of the US Treasury, despite that the US Treasury is also moving up as well in the last 2 or 3 days or so, the last 3 days. So everything is relative when we are looking at intermarket analysis perspective. All right, so this covers the intermarket perspective right now. So and as well as yesterday's key event or data that was released. So now let us now have a quick, before we jump straight into the short-term technical outlook, one more event that took shape will be RBA minutes. So the RBA minutes was actually released earlier, 1 hour earlier. So during the minutes, the officials discussion, that's one key thing. Returning 2 to 3% target remains the highest priority. And what they actually meant over here is that there could be a chance of a rate hike discussion on renewed inflation concern. That means, i.e., potentially the RBA is also not as dovish as market wants to be. Okay, so the RBA itself is now skewing also towards the camp of the US Federal Reserve officials concerning about resurgence of renewed inflation concern, but they are much more hawkish than the Fed, because still remember Powell last week saying that the next step for them is to do a cut, but it's only when to cut, but rather than a hike on the Fed funds rates. While for Australia, the RBA still keeping the cuts of a potential rate hike instead. That means the next decision could be a hike. Okay, because they're still keeping this cut in their pocket, okay, or in their toolbox because of this renewed inflation concern. Okay, so that could actually also potentially keep the Aussie dollar on a being supported within this medium-term symmetrical triangle range configuration that I highlighted every day in my short-term technical outlook, which I will do so later on. All right, so with that, now let us now jump straight into that short-term technical outlook. Firstly, let us start with the FX market first. So on the FX market, let us take a look at the heat map. The rolling 5-day performance. Pardon me. Excuse me. Okay, so this is the 5-day performance of the major currency using the dollar as the base currency versus the rest of the other popular traded currency as of now. So this is the 5-day rolling performance. So I could see over here is that overnight the dollar strength starts to come back because the dollar index remains unsupported. So the dollar strength is being seen more pronounced on against the Swiss franc and against the CNH. Then third ranking will be against the JPY, against the Japanese yen. So the Japanese yen this time around didn't actually rally as steep as possible. Okay, previously during the previous bout of dollar strength being supported and resurgence, you could see previously the dollar yen was the one that is rallying the most. So this time around, why the dollar yen didn't move up as much is because, like I shared with you earlier on, the fundamentals between the yield spread between the 10-year treasury yield over the GGB yield, both the 10-year and 2-year, doesn't really actually support a very strong dollar yen movement on the upside. All right, so that should explain why this time around the dollar yen right now is not moving as strongly as in the past, despite that the dollar index is being supported yesterday due to the Federal Reserve officials speaking. The some that is skewing towards the less dovish side of the camp, causing the 10-year treasury yield and the 2-year treasury yield to recover after that sell-off on last Wednesday exposed CPI data. Okay, so that explains the movement. All right. So now with that, let us now quickly take a look at the dollar, the major dollar FX pairs that we use to cover in our short-term technical outlook for our daily dose, starting from the European currency. Okay, so let us start with the euro dollar. Euro dollar over here. Okay, now let me expand my screen so that you guys could see. Okay, so the euro dollar continues to actually inch slightly lower, but it still can't break below last Friday low over here at around that 1.0835, which is slightly above our first support level at 1.082. And what we could see is that momentum is so weak as the RSI continues to shape a series of lower high. All right, inching lower. So net no change. The 1.09 level will still be the short-term pivotal resistance level to watch out for. So I do not want to use this level over here. So this is yesterday's high. So this could be the first, oops. Okay, so this could be the first support level, first resistance level to watch, pardon me, yesterday high, but I don't put it so tight as my short-term pivotal resistance. I will still use 1.09 level, which is that swing high managed to get inflicted, expose US CPI data before start to trade sideways. So no change using 1.09 level as my short-term pivotal resistance level on the euro dollar, still maintaining that short-term bearish bias for this potential corrective decline to take shape. First support level to watch will be at 1.0825, then thereafter a break below it exposes 1.08 figure level, which actually confluence with the former minor swing high of 3rd of May and 13th of May, and also confluence slightly above the 200-day moving average, acting as a support. Only an hourly close above 1.09 level invalidate this corrective pullback scenario on the euro dollar to potentially see the continuation of that rebound for the next intermediate or near-term resistance to come in at 1.0925 slash 0.940, which is the top of the minor ascending channel that I drew from the low of 1st of May. Above it exposes 1.096 level. Okay, 1.096 level, which confluence with the minor swing high of 8th of March and 14th of March. So that's for the euro dollar short-term technical outlook. Moving on, next will be the sterling dollar, the cable. So the cable yesterday tested the 1.2710 short-term pivotal resistance before trading in a very tight range. So the sterling dollar is not as bearish as you could see in the price action as compared to the euro dollar, but the momentums continue to wear off by this bearish, very clear bearish divergence despite it trades sideways. But the RSI starts to slope downwards yesterday as well. So indicating to us of that lack of upside momentum in the sterling dollar. So with that negative momentum, with that lack of momentum, upside momentum observation being portrayed on the hourly RSI, as you show on my screen here, I will still maintain that short-term bearish bias with a slight excess above 127.10. I use 127.40, which is the 0.38 Fibo extension of this current up move, taken from the low of 9th of May, and also conferencing with the top of that minor ascending channel that I drew from the low of 22nd of April. Okay, so as long as 127.10 access 127.40 short-term pivotal resistance didn't surpass for today, still maintain that short-term bearish bias for that minor corrective decline scenario to potentially unfold in the sterling dollar. Next support level to watch for sure will be at 126.40 slash 126.10. Below it exposes 125.65, which is the minor area of 7th of May and 13th of May, which also confluence quite closely to the 200-day moving average, acting as a support as well. Only an hourly close above 127.40 will invalidate this minor corrective decline scenario to see the continuation of the rebound to expose the next near-term resistance at 128 figure level, followed by 128.60 on the sterling dollar. Next will be the Asia Pacific currency. So let us start with the give me a minute, where is it? Yeah, let us start with the dollar yen. So dollar yen, it rallied yesterday, but this rally is now back to that 157 figure level, which is also a Fibo retracement of that previous decline from 29th of April to 3rd of May at the golden ratio of 61.8%, and also correspond pretty much closely to that 14th of May swing high before that minor decline takes shape again. So, and also the RSI now is actually back at the overbought region. All right, so with that, I would rather have a neutrality stance for the dollar yen for today, neutral between 157 figure and 155.30, acting as a lower limit of the neutrality range, which also confluencing with the 20-day moving average, acting as a support. Only an hourly close below 155.30 will expose short-term minor weakness on the dollar yen for the next near-term support level to come in at 154.30. A break below it exposes 153.30, which confluence with the upward sloping 50-day moving average. All right, that's for the dollar yen. Okay, then for the Australia dollar, so the Aussie dollar right now continues to actually inch much lower, and it's now hitting the first support level that we highlighted at 166.45 slash 66.20 level. All right, from here. So with that, I will actually still the RSI, there's no bullish divergence on the RSI. RSI going to shape lower low. All right, it's now touching the oversold region, but despite the fact that RSI oversold, it doesn't mean that it will stage a bounce from here. So given the fact that yeah, we know that the RBA tends to be much more rather hawkish than dovish in the RBA minutes over here, but in the shorter term, I will still respect the short-term technical elements, okay, at this point in time. And do not forget the other dollar major pair, like the euro dollar, the sterling dollar, and even the dollar yen, doesn't show any signs of very clear signs of dollar weakness. All right, based on their short-term technical configuration that I flashed earlier. So with that, right, I will still maintain that short-term bearish bias on this Australia dollar. So I will use this level. So instead of having that pivotal at 67.50, okay, I will tighten it. So right now what I'm going to do is, let me reduce this here, get this level. Okay, so this is no longer the short-term pivot. Okay, so this is yesterday's swing high over here at 0.710. Okay, 1.0710. Okay, so I use yesterday's high 67.10 around up. Okay, 67.10 as my tighten short-term pivotal resistance level. Okay, so this level here will maintain my short-term bearish bias on the Australian dollar. So if we start to see a breakdown below 66.20, it will expose the 20-day moving average, also acting as a support that's confluencing with this minor congestion area here at 65.85. All right. Only an hourly close above 67.10 would negate this bearish tone on the Australia dollar to see a potential resurgence of that rebound to test 67.50, followed by 67.80, which is the top of this minor ascending channel that is in place since the low of 19th of April. Okay, so this 67.80, 67.50 is rather important. Why? Because this is considered as a medium-term resistance level. If you look at the daily chart over here, this is the daily chart. Okay, so this daily chart of the, okay, where is it? Yeah, this is the daily chart. Okay, so this daily chart over here, what we could see that the Australian dollar continues to be trapped within this symmetrical triangle range configuration. It's a medium term one because it's a daily chart of the Australian dollar since the low of 13th of October last year. Okay, it continues to actually play out this way. Why? Because it's being supported by a not so dovish RBA that preventing the Australian dollar from sliding much lower since 13th of October last year. But nevertheless, on the top side, we still see being subjected to this symmetrical triangle range configuration that is preventing any further rally, and it seems to be working right now from a technical perspective, because in the last 2 days or 3 days it starts to form this rather not so bullish candlestick that's been displayed in the last 3 days or so. Okay, right below the 67.30 range resistance level, which is the upper limit of the symmetrical triangle on the Aussie dollar. Okay, something to actually take a look out for from a medium-term perspective. Is still trapped within that symmetrical triangle range configuration since 13th of October last year for the Australian dollar. So that pretty much sum up for today's short-term technical outlook on the FX market. So what we could see over here is implying a bit of dollar, short-term dollars being on support and with potential short-term strength resurgence coming into play from a very short-term perspective on the intraday basis. That's for the FX market. So now let's immediately jump to the major stock indices. All right, so major stock indices, very quickly, let us take a look. Okay, no, is it here? Yes, this is the one. Okay, let's take a look at the Hong Kong 33. Okay, so the Hong Kong 33 continues to trade. Okay, so today, okay, so let's have a bit of excess. So now it's actually testing the lower, testing that 19,300 short-term pivotal support that we highlighted yesterday. Also the lower limit of this minor ascending channel at this point in time. So let's have a bit, so I'll have a tolerate a bit of excess, okay, on the Hong Kong 33, which is the Hang Seng Index. Okay, over here. Okay, a bit of excess at this level, which is 19,300, 19,260. Okay, so I will use this level as a short-term pivotal support, and the RSI is now at the oversold level as well, right at the oversold level. So as long as this level didn't surpass to the downside, still maintain that short-term bullish bias on the Hong Kong 33. Except for today, I will have a short-term resistance. That's this level here. Okay, 19,620. A break above 19,620 potentially sees the next intermediate resistance to come in at 19,820. Only hourly close below 19,260 will invalidate the short-term bullish bias to expose the next support area. That means this minor corrective pullback will tend to extend towards 18,965, followed by 18,680, which is coming close to the upward sloping 20-day moving average, acting as a support level as well. And if we do the entire Fibo retracement of this current push up, the 18,965 correspond to that 23.6% Fibo retracement. All right, for the next supports. Okay, after the break of the 19,260. So that's for the Hong Kong 33. Nikkei 225, which is the Japan 225, no change, continues to actually hit the first resistance at 39,500 yesterday before attempting to trade in a sideways configuration. So what we could see over here is that it potentially is forming this potential kind of a so-called bullish pennant formation. Okay, bullish pennant formation after that sharp rebound or the breakout of that range okay, that is in place since 7th of May. So it's a kind of a bullish continuation pattern, a pennant that is forming right now in the Japan 225 or Nikkei 225. So no change. I will still use the 38,930 as a short-term pivotal resistance support level. I repeat again, 38,930 as the short-term pivotal support level to maintain this short-term bullish bias on the Japan 225. So with that, still maintain that short-term bullish bias. First resistance 39,500, a break above it exposes 39,810, 39,990, which confluence with this minor swing high area of 9th of April, 12th of April, and as well as 5th of April. Okay, this bunch over here. Only an hourly close below 38,930 will invalidate yesterday's bullish breakout to see another round of choppy corrective decline to expose the next support area at 38,520, 38,300, which also confluence with the 20-day moving average acting as a support level as well. Okay, German 30. So for the German 30 over here, price action yesterday managed to bounce off from that pivotal support that we highlighted, 18,640. So then thereafter it trades kind of did that minor pullback. So still no change, still using that 18,640 as my short-term pivotal support to maintain that short-term bullish outlook. All right, first resistance to watch for sure will be the current all-time high area on last Thursday at 18,920. Above it exposes the next near-term resistance at 19,030, 19,070, which is a FIBO extension cluster level. Only an hourly close below 18,640. We also confluence with the lower limit of this minor ascending channel that I drew from the low of 19th of April. May see an extension of a minor corrective decline towards 18,470, which is the rising 20-day moving average. A break below it exposes 18,320, which confluence with the minor swing high of 24th of April, and as well as the 50-day acting as a support close to it at 18,320 as well. Then what we have over here will be the US market. So before we start touch on the US market, right, I want to share with you why NVIDIA is important. Number one, it has a higher configuration, a higher component weightage. It has a significant component weightage, which is the third biggest weightage component stock in the S&P and the Nasdaq 100, and as well as its momentum is the strongest right now among the 7 mega cap stocks. Why do I say that? If you look at this performance chart, year-to-date performance chart as of yesterday, we could see NVIDIA is the top of the pack, having a year-to-date return of 97%. Okay, and you look at this gap is significantly huge compared to the Magnificent 7. I include in the Netflix as well inside, only up by 32%. NVIDIA is considered a semiconductor stock, and within that semiconductor sector, the semiconductor sector is only up 26%. And if you look at the Nasdaq 100, it's only up about 13%, the S&P around 12%. All right, so if you look at the current outperformance momentum gap of NVIDIA, very clearly in terms of the momentum factor, NVIDIA is leading the pack among its peers, which is the Magnificent 7, and among within its semiconductor industry. So whatever happens to NVIDIA after its earnings release on Wednesday, in terms of momentum, it could actually drive the momentum bias in the short term on the Nasdaq 100, the S&P 500, and to some extent the Dow Jones Industrial Average, due to the its reflexivity loop. All right. So with that, right, let us take a quick look. And we know that's why we know NVIDIA is rather important. So let us have a quick technical outlook analysis on the NVIDIA to actually have some assessment whether it still has a bullish momentum at this point in time before the release of its earnings. All right, so look at the technical chart of NVIDIA over here. Okay, very clearly, right, it's still trading in a medium-term uptrend. All right, after the close above its 50-day moving average. All right, no clear signs of a bearish exhaustion. Then how do I know that? If we will look at the RSI is actually shaping upwards. Okay, it's shaping upwards over here, and also it started to break out previously. Okay, and it's not even at the overbought level as well. So indicating to us that the medium-term momentum is rather positive on NVIDIA, and which translate to the fact that the medium-term momentum outlook is bullish for NVIDIA rather than bearish. So this gives us a kind of a gauge that we know that NVIDIA is important in terms of its weightage inside the S&P and the Nasdaq 100, and as well as is the leading momentum factor among its peers in the Magnificent Seven and the semiconductor sector that is leading the S&P and as well as the Nasdaq 100. Okay, so given that this big boy, potential big boy, is still positive in terms of momentum factor, higher odds is skewed towards the Nasdaq 100 to maintain its short-term bullish bias outlook. So this is what I'm trying to actually do, that interplay, all right, in the terms of feedback looping among a key component stock within the major US stock indices. So with that, let us very quickly jump straight into the technical outlook of the Nasdaq 100. So on the Nasdaq 100, we start to see a breakup above a fresh all-time high on yesterday. Okay, so this level here is no longer resistance anymore, the 18,660. So this will be something like a pullback support level. Okay, so the pullback support level to watch out for will be 18,660, followed by this region here, which is yesterday's swing low at 18,580. Okay, but I don't put it so tight at 18,580. I will actually use this 18,465, which is i.e. slightly adjusted short-term pivotal support for today to maintain that short-term bullish outlook on the US Nasdaq 100. 18,465 above this level exposes 18,850. Okay, no, sorry. The next resistance to watch will be at 18,850, which is a one-time Fibo extension level, followed by 18,990/19,055, which is the Fibo extension level of 2 times taken from the low of 19th of April, and 1.266 times taken from the low of 2nd of May. So it's a Fibo extension cluster level at the 18,990/19,055 after 18,850, and also the 18,990 also confluence with the upper limit of this accelerated minor ascending channel for 1st of May. Only an hourly close below 18,465 will negate this bullish impulsive up move or invalidate it to kickstart another round of minor corrective decline to expose the next support area at 18,250, followed by 18,100 level, right? 18,100 level. Okay. Now, Dow Jones Industrial Average, lastly, US Wall Street 30. So US Wall Street 30, no change. Still using that 39,770/39,600 as my short-term pivotal support level after the price pullback to it yesterday on the upper limit. And this 39,600 level also confluence with the minor ascending channel support level that I drew from the low of 1st of May. So this accelerated minor ascending channel support after price action breakup. All right. Okay, so RSI also right now turning up from the oversold region. Okay, indicating to us that yesterday minor pullback may have started to lose its downside momentum. Next resistance to watch out for will be at 40,360, 40,430. All right. Okay, so I will have a first resistance to watch out for will be this level here, which is yesterday's minor swing high at 40,050 level. Okay, first resistance 40,050, above it 40,360, 40,430, which is a Fibo extension cluster level, and as well as the top of the upper limit of this accelerated minor ascending channel from the low of 1st of May. Only a breakdown below 39,600 will invalidate this move to expose 39,260, followed by 38,970. Okay, so very quickly, lastly will be spot gold, XAU/USD. So for spot gold over here, let's take a look at spot gold. So yesterday the price action hit the first resistance at 2,450 level. Okay, so price action now managed to bounce from this minor the first support that we had yesterday at 2,410 level. So still no change. I will still be using. Okay, let me open up the RSI. Okay, so RSI is kind of sloping downwards. Okay, that means there's still a chance of hitting the oversold region. Hasn't hit the oversold region yet. So given the fact that there could be this minor extension of this pullback yesterday after hitting 2,450, so I would not want to tighten that 2,410 level as my short-term support, pivotal support. So still maintaining at the 2,395, given the fact that the RSI hasn't hit the oversold region. And also, if you look at the short-term stock, the much more sensitive stochastic oscillator, also showing very similar movement as well. It hasn't hit the oversold region yet. So given the fact that both haven't hit the oversold region, I would not want to tighten the key short-term pivotal support level. So still maintain at 2,395 for that bullish bias to maintain. First resistance to watch for today will be at 2,450. Above it, exposed 2,480/90. Only an hourly close below 2,395 will invalidate this short-term bullish outlook on spot gold XAU/USD to expose the next support level at 2,375, followed by 2,355. All right, then what's next will be the West Texas oil. So West Texas oil continues to actually be hampered by the 200-day moving average, can't break above it yesterday. So I will use yesterday high as my first support level, first resistance level, 80.50. So still using the 77.20 as my short-term pivotal support level. Only a breakout above 80.50 will see a bit of much more pronounced momentum coming in for West Texas oil to more pronounced positive momentum coming in for West Texas oil to expose the next resistance at 81.70, followed by 82.60. Only an hourly close below 77.20 will invalidate this potential bullish outlook on West Texas oil to see the continuation of a very messy corrective decline to expose the next support area at 75.50, followed by 73.60. All right, so that sum up for the short-term technical outlook on the broad-based cross asset classes. So before we go, let's take a look at the economic data for today. What are the key things to look out for? All right, so for today, after the release of the RBA minutes, we have a rather quiet European session. We do have Canada inflation that is out later at 8:30 p.m. Singapore time. And we do have also these two officials speaking again. Well, we have a couple of officials speaking at around between 9 p.m. to 11:45 p.m. Singapore time. So starting with Fed Baking at 9 p.m., followed by Fed Wheeler also at 9 p.m., 9:05 Fed Williams, then Fed Bostic will be speaking again at 9:10 p.m. Singapore time, followed by Fed Bar also will be speaking again at 11:45 p.m. Singapore time. So we do have a slew of Federal Reserve speech later during the US session for today. Then thereafter will be a pretty much quiet session, followed by early Wednesday Singapore time, 1 a.m. we have the BOE Governor Belly speaking. All right, and we know that tomorrow Wednesday will be Visa Day, so there will be no daily dose for Wednesday for tomorrow. And do keep a close eye watch on the earnings calendar at the close of the US session tomorrow on Wednesday. That means on Wednesday, US session close, like I mentioned earlier on, we have that all important NVIDIA results. And the earnings EPS consensus is rather very rosy, almost an increase of 5 times from the previous EPS 1 year ago at 1.09. All right, so market now is pricing in at $5.58 for this quarter, this time round quarter Q1 EPS earnings. All right, so with that, this is Kelvin Wong here again signing off from today's Daily Dose. Just a reminder, tomorrow will be Visa Day, so there will be no Daily Dose for tomorrow, and Daily Dose will resume again on Thursday. So do have a great day ahead and a great restful and blessed Visa Day as well. Thank you.